Hey everyone, welcome back to Upside Down Data. Today I want to talk about ETH, the merge, and what we might expect to happen with its price after this big event happens. Like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. A lot of updates, better indicators, and more over there. So the way that I want to talk about this is first laying out the bull case of kind of the arguments that I've seen for why people think that ETH's price is likely to surge after the merge happens. Then I want to lay out the bearish case and why that might not be as likely to happen. So let's go ahead and get into it. So if you're not familiar, the merge is this big event where Ethereum is going to transition from being a proof of work network to a proof of stake network, and it's coming very soon. So Google actually has this countdown as a record. They're estimating it's going to happen, or the merge is going to be initiated in about 5.5 hours from when I record. So with this coming up, let's talk about what could happen to the price. So there are different kind of narratives that are out there. So for the bullish narrative, one of the kind of main arguments I've seen people put out there is that the economics, the tokenomics of ETH are going to change in such a way that it will make for a positive price movement a lot more likely. And specifically what a lot of people point to is that after the merge, the issuance of ETH and the new ETH being created will be substantially lower than it is right now. So this here is an article on Seeking Alpha that has a nice summary of what some of those changes in the tokenomics of Ethereum are once the merge happens. But in brief, ETH is going to go from minting about over 4 million ETH per year to about 0.6 million ETH per year is the estimate. And then with the EIP 1559, which is an upgrade made to Ethereum last year, a lot of actually the transaction fee gets burned when a transaction happens. And so the idea is that with this decreased issuance rate and with the burns on transactions, ETH could actually become deflationary, that it could actually start being the case that fewer and fewer ETH exist over time, which actually set it apart from something like Bitcoin, where Bitcoin, up until the final Bitcoin is mined, which is many years from now, Bitcoin is actually inflationary. It's just that it's fixed and it's predictable how inflationary it is. The argument here is that ETH could actually become deflationary, and then that could create what a lot of people would call the supply shock, where suddenly there's very little supply available and a lot of demand willing to buy it. That can really make the price shoot up. So that's one of the arguments people are putting forward for why the merge will be super bullish for ETH, is that it will create this supply shock. There will be less and less supply available to be bought, and that'll increase the price. The other thing that people have talked about, the other kind of bullish feature of the merge, is some people are speculating that institutional buyers might be more likely to get into ETH after it switches to proof of stake. And the reason is that, in some jurisdictions, proof of work blockchains are either banned or are, there's legislation being put forward to ban them. So in other countries, even talk about that in the US, although nothing has really moved forward on that front yet. And so the idea would be that institutions might be hesitant to get into something that they think might lead to regulatory problems, like if suddenly there's a ban on proof of work blockchains, then that would not be great for institution. But the proof of stake system kind of shields them from that, because a lot of the reason for these proof of work bans, or at least the proposals, is environmental concerns with the energy consumption that proof of work takes. Proof of stake is way more energy efficient than proof of work. And therefore, the idea would be that institutional buyers might say, okay, I'll get into ETH now when I'm more confident it's not going to run into these big issues, these big legal issues, versus when it's still proof of work, they might be more hesitant. So those are kind of the two big narratives. There are probably other ones that are out there. Feel free to leave in the comments other narratives you've heard, but these are the two biggest ones that I've seen for why people think the price of ETH will go up after the merge. And it's possible, right? But I want to talk now about why my base case is not either of these. My base case is not that ETH is going to explode after the merge. And there's several reasons for this. So the first thing I want to talk about is just more explicitly kind of arguing against this supply shock argument. And the thing I want to point to, the data point I want to point to here, is let's look at the gas prices on Ethereum. So with Ethereum, you have to pay gas fees to do a transaction. So if you want to make a transaction, you have to pay some amount of gas for that transaction to happen. And gas fees, are variable in how much they are. And it really depends in no small part to demand on the network. The greater the demand is for the network, the higher, generally speaking, the gas price will be. And so we can look at gas fees, or the level of gas fees, as a proxy for current market, or excuse me, current demand for Ether block space. So for getting your transaction into the Ethereum blockchain. What we can see was that really from kind of mid 2020 all the way up through even the beginning of this year, gas prices were fairly high. You know, there was a dip down in the summer when there was that big crash kind of in the crypto markets. You know, not as big of the crash as we saw more recently, but kind of that crash before the second kind of leg of the bull market going into the fall and November. Well, you can see that we've been in a very notable, just very distinct downtrend ever since the beginning of this year. You can see that demand for the Ethereum blockchain to be using the blockchain has fallen off. There's less and less demand, less usage. And so for this argument that people are going to just suddenly, there's going to be this huge surge in demand that's going to, you know, they're going to make the price catapult. Right now, we're not seeing anything about demand manifesting here. You know, there's not any signs that desire to use the network is increasing right now. In fact, it's actually decreasing right now. So there's not really any sign that this demand is going to show up and make this supply shock happen. This narrative honestly reminds me a lot of a narrative that was happening with Bitcoin going into, you know, the fall of last year, you know, November of last year, when we had, you know, ultimately what was the top, was that a lot of people were saying that there was a supply shock coming, that there's this metric called illiquid supply, which is the idea that there's these entities that tend to take in Bitcoin but then don't spend them. And so these entities were kind of acquiring more and more Bitcoin, and that there just wasn't going to be Bitcoin available when this kind of new surge of demand comes to demand for it. The problem was that surge in demand never came, and then we saw exactly what happened after here. And so I think with these kind of supply shock arguments, you have to be careful, because they assume this surge in demand, where in the current economic climate, that's what I want to talk about next, it's unclear why we should necessarily expect a big surge of demand to come immediately. And I want to transition into that next. So one of the things that markets have been reacting quite strongly to over the last couple of days was the August inflation print, the August CPI print. I'm showing you here a summary of that from the US Bureau of Labor Statistics. So what we're looking at here is month or percent changes in CPI. And so this was the August one that just came out a couple of days ago. And so the issue here is that it came out higher than expected. So I think the overall estimates were somewhere around 8 to 8.1% year over year on the headline, kind of the all item CPI. And then for the core CPI, which is this all items less food and energy, so kind of taking out the more volatile components of the CPI, this also came in hotter than expected. And the thing that also freaked people out, or the market out, was that the month over month change, so from July to August, was positive on the headline, where it was expected to be negative, and it was higher for core CPI than people expected. And it's really this core CPI that I think really freaked a lot of people out, because that's what the Fed looks at. That's what the Fed pays more attention to when they're making decisions about raising interest rates and things like that. And of course, then the market had a very pronounced reaction. So if you look at ETH itself, you know, ETH sold off. You know, that print came back out here on September the 13th. And, you know, ETH sold off 8.3-ish%. You know, Bitcoin sold off even more. That was down almost 10% on the day following that CPI print. And then the stock market also did not like that at all. We can actually see, you know, the stock market fell. The S&P 500 fell 4.3%. The NASDAQ a whopping 5.5%. And the Dow Jones down around 4%, which in the stock market is a huge move for the major indices in a single day. The markets did not take that CPI data well at all because of what it heralds about the Fed. That means that the Fed is likely to kind of turn the screws even harder on the economy. They're going to raise interest rates probably either faster or to a higher level than the market thought before. And so that's just not going to be great for anyone. There's just going to be tighter and tighter monetary conditions. That is, you know, has been ever since, you know, all the way back here for the stock market back January this year, and then even earlier, you know, from November this year, just been bad news for risk assets. That the more the Fed has been tightening financial policy, generally speaking, the more downside we've seen in the stock market. And so that's really what people were reacting to. And the bond market also reacted. We saw a sell-off, for example, on the 2-year bonds, and that's reflected in the yield going up, which suggests that bond market participants expect the Fed to hike to a greater degree than they did before. We also saw the dollar put in a pretty notable rally on that day. And again, when the dollar's going up, tends to be bad for risk assets. So with those things kind of on the bigger picture of how markets are reacting, what the Fed is likely to do based on that inflation data, that's another thing where to think that there's going to be this big surge in demand all of a sudden for ETH during this kind of very negative macro environment, it's hard for me to make that my base case. Obviously it's possible, anything could happen, but it's really hard for me to make it my base case. So that's kind of what I'm actually more expecting. So I'm expecting the merge to be a sell the news type of event. I'm actually expecting ETH to not surge immediately. I'm actually expecting short-term downside movement from here. And so if that's the case, let's talk a little bit more about that. And I also, just to kind of put a finer point about this, I want to pull up some other some models that we have here on the channel to kind of give another perspective on this. So what I wanted to talk about first was the market direction classifier, or MDC. So this is an indicator that we have here on the channel that just basically tries to classify whether or not a general bullish disposition on the asset makes sense or bearish. And so the way this model works is that it creates a dynamic critical level across time. And if the asset pops above it, that tends to be bullish. Falls below it, that tends to be bearish, and greater downside happens. And so generally speaking, buying above, when we flip above, selling when we flip below, generally speaking, will get you out of the worst of the down and get you in for the best of the up, is really how this model works. And so now the MDC right now for Bitcoin is watching a critical level of about $1,538. So the exact level isn't super important, but just generally in this ballpark, that's what it's watching as being this kind of important level for Ethereum to hold. And if we don't, as I was just speculating, and again, if we go back to the price chart, we're already just only a little bit above 1,600. So to get back down to those levels is not very unrealistic from here. If we just go ahead and measure from current levels down to about 1538 or so, it's only a 4.3% move to the downside. That's just another Tuesday in crypto. That's just another day in crypto. So it would not be difficult at all for ETH to lose this level. And then if that happens, then the MDC's bias flips bearish, and it would just be confirmation that a bearish move might be more likely in that scenario. The other thing I'm looking at that also makes me concerned for Ethereum. So I want to show this. So this is actually from a sneak peek from the website that we're developing in collaboration with Jay over at Daily Crypto Analysis. I'll leave a link to Jay's channel in the description. You should definitely check him out. He makes great videos about crypto markets. And what one of the features on this website is going to be this kind of overall view, this dashboard that'll let you see a bunch of different model information, including risk information across all the different assets. And so I wanted to pull this up because I think it shows another reason why being skeptical about ETH's ability to just go crazy in the short term is a little bit unrealistic. And really what I want to show is it compared to other assets on these levels. So if you're not familiar with our UDPI risk indicator, this is basically a risk indicator. So it goes from -5 to 5, and the closer you are to -5, kind of the lower risk, the closer you are to 5, the higher risk the asset. And so since we're in very much a bear market right now, most of these assets are below 0. But I want to look at the relative difference between them. So I've highlighted the ETH UDPI levels here. So short-term negative 0.91, medium negative 1.11, long a little bit above 0. And these are just different time frames that the model focuses on. So we have a version of the UDPI that cares about moves that play out over days to weeks. That's the short term. Weeks to months is the medium term. And then months to multiple months is the long term. What you can see is that the ETH UDPI levels across all the time frames are almost the highest across categories, or the highest. So for the long term, the only ones that are higher right now are Matic and Atom. For the medium term, the only ones that are higher are Atom, and I think that's actually it. I believe that Atom is the only one that's higher, and I think it's the same case for the short term as well, that only Atom is higher. Atom's been performing exceptionally well recently, so it's not really a surprise. And so the reason that this makes me kind of worried about ETH is that, one way you could look at this and say, oh, wow, ETH is really overperforming the rest of the crypto market. Look at how it's able to hang out at these higher risk levels than everything else. Possible, but what I think is probably more likely is that ETH has been kind of defying gravity for a while based on the hype of the merge. And then once the merge happens, I actually expect it to go back and find that ground again. That it's been defying gravity for too long. That gravity is going to kick back in and probably pull the price back down. And frankly, the same outlook, I would have the same outlook for Matic and Atom as well. That to believe that ETH is just going to be able to keep on defying gravity and stay well above while the rest of the market is clearly at these kind of lower levels, are clearly less extended, less overextended than ETH is right now, I don't find that very convincing. Could happen. I just don't find it very convincing. That's one thing I think is a good utility of the UDPI is that you can look at it not just for the asset itself, but across other assets. And it gives you an idea about how the asset might stack up going forward or what we might expect. And if generally speaking, we expect assets to kind of generally revert to the mean of whatever the kind of overall UDPI at level is at a given moment, I expect the same thing for Ethereum, which is probably going to mean that downside is needed. Okay, so then just to wrap us up, what are some price targets we might look at if that does end up playing out? So let's go ahead and just take the ETH chart here. I'll just zoom back out a little bit and look at the volume profile kind of across, going all the way back to kind of the top back in May, or the local top at least that it was back in May of 21, all the way to where we are now. And we can see where volume is transacted, what different price levels, how much volume is transacted at those different levels. And the reason we care is that the more volume that's transacted there, the more likely there are to be people who have their cost bases there. And so if you're moving up into people's cost bases, that oftentimes acts as resistance. That's another thing that would concern me about a move up, is just look at how much potential resistance there could be if there's still a decent number of people who have their cost bases in ETH up here. Whereas to the downside, there's not a whole lot of volume that transacted down at these price levels, kind of below 1,500 levels, at least in more recent history. And then kind of the next level where we see a big spike is all the way back down at 1,200 down to closer to 1,000. And so my kind of best guess, just looking at this, would be that if we do end up seeing that sell the news type of event, it would not shock me at all, and it might actually be my expectation that ETH has to go back down and retest this range. Maybe it finds support back up here and is able to bounce it around the 1,200 level, or we have to go all the way back down into this range if we're able to hold this and don't have to set new lows. So again, a bearish outlook, but that has to be my base case based on the data that I'm seeing. That it would be disingenuous for me to say that I'm overall leaning bullish here versus bearish just based on everything that I'm seeing. But again, I'm open to being wrong. And so we're going to have to wait and see, what ends up happening after the merge transpires. And, certainly I'm not going to be one of those kind of perma bears where if the data if my bearish thesis becomes invalidated, I just refuse to budge on it. I have to be flexible. But overall, just looking across these data, my base case has to be more bearish and more sell the news. If you have a different outlook, I'd love to hear it in the comments. I'd be curious to hear what your thoughts are and why you lean in the opposite direction. But those are my thoughts. Obviously not financial advice, just what I'm seeing in the current data. All right, if you like the content, remember to subscribe to the channel, give the video a like and follow us on Twitter. A lot of updates, indicators, and more over there.